Hello friends, good morning.
Good
Good
morning.
morning, sir.
Good morning, sir.
Good morning,
Good
sir.
morning, sir.
Yes, good morning. Shall we start?
Yes, sir.
Yes, sir.
Yes, we'll quickly continue, rather start the discussion on the revision of IDT. So in the next 2 hours, we will cover the entire concepts, the overall discussion on what are the main concepts that we have learnt. We'll quickly revise those things. Since we have discussed these things in the last few months, you will be able to connect better and it will help you to further prepare on these aspects, right? So obviously we'll be focusing on the main provisions. The related aspects you'll obviously be able to build upon it. Okay, that's how this session will be panned out. So we'll not waste our time. We'll start with the first chapter. We started with supply, which is a section which talks about supply.
Seven.
Seven.
Yes, section 7 talks about supply. Section 7 says supply discussion can happen through three different subsections. 1, 1A and 2. Subsection 1, supply includes 71A, AA, B and C. 71A says supply includes supply of goods or services or both for consideration in the course or furtherance of business. The three parameters, the base based on which the entire aspect of GST is built upon. The three parameters. So there we learnt about the concept of supply of goods and services. So to understand that, we discussed the definition of goods. 2 clause 52 talks about goods, correct? Goods means any kind of movable property. It includes actionable claims, growing crops, anything part of the land which is severed or agreed to be severed before the time at the time of supply. But it excludes money and securities. Similarly, the definition of services that we learned 2 clause 102, anything other than goods, and it includes use of money, conversion of money from one currency to another, one denomination to another, where separate consideration is charged. Only then it will be considered a supply of service, and it excludes money and securities again. Correct. We also discussed about the definitions of money and security. Money rather, Securities Contract Regulation Act. So money, again, any kind of currencies, travelers check, all those things. However, it excludes money held for rather numismatic value. Very good. Yes, for money held for numismatic value should be excluded. That is first parameter. Then we went on to the second parameter, consideration definition. It said any amount paid or payable for that supply of goods or services or both, by whom? By recipient or any other person. It can be in money or money's worth. Correct. That's the definition. Security deposit discussion. Yes, it will be considered as a consideration only if it is non-refundable. If it is refundable, not a consideration. Then in the course of furtherance of business, yes, the definition of business we have already learnt. Then double A talks about services provided by an association or club to its members. Again here, all the three parameters have to be satisfied. It should be for consideration, only then it will be considered a supply. So more or less this is a clarificatory provision that has been made, right? Then 7(1)(b) talks about only two parameters, S and B, correct? No, S and C, supply for consideration. So what is 7(1)(b)? Import of services for consideration. Here, whether or not in the course of furtherance of business, whether it is for the business purposes or not, doesn't matter, it is deemed to be a supply. 7(1)(c) talks about S and B, deemed supplies without consideration. So this we would refer Schedule 1. Correct. In Schedule 1, we had 4 items. Permanent transfer and disposal of business asset. What is the condition there?
ITC should have.
Yes, their ITC is availed. Second, supply between related persons and distinct persons. So there we understood related persons and distinct persons concept. The definition of related persons we have discussed: employer, employee, directors, partners, right? Persons having control over a company, greater than or equal to 30% of the shareholding, 25% of the shareholding, right? A common control, all those. Along with that, we also discussed family members. Members of the family are also related parties. Family members definition: spouse and children always, parents, grandparents, brothers and sisters only if they are wholly or mainly dependent. Right? That is related parties. Distinct persons, if the entity, those entities should be under same pan. If they are in different states, even if one of the state is registered, then it is considered to be registered, rather distinct person. If they are in the same state branches, then they'll be considered as distinct persons only if they are separately registered. Right? That is the concepts of related persons and distinct persons. Then principal agent. What is covered in principal agent?
Only goods.
Only goods. Very good. Supply of goods only is covered. Then last one was continuation of this: import of service. Here it is without consideration. Therefore it should be in the course of furtherance of business. In the course of furtherance of business, and should be from
Related person.
related persons or establishment outside India. Same establishment, correct? So only then it will be considered as deemed supplies. So import of service, two discussions: with consideration, without consideration. If it is with consideration, always a supply. If it is without consideration, then I have to see from whom we have received it. If we have received it from other than related persons establishment, not a supply. If we have received it from related persons or establishment of the same entity outside India, then I have to see for what purpose I have received it. If I have received it for business purposes, deemed supplies, else not a supply. Correct? This is subsection 1. Then subsection 1A spoke about classification. Basically, we'll be referring schedule 2 there for classification of goods and services. Our main discussion there is: if there is transfer of title, it is goods. If there is no transfer of title, it is just transfer of possession, use, right of use, etc., then it is supply of service. There are some specific points that we discussed in relation to it could be tolerating an act, to do an act, or refrain from an act. In all those things, it will be considered as supply of service only if two conditions are satisfied. There should be an independent contract and consideration should flow from such contract. Two conditions are satisfied, then it is supply, else it is not a supply. We discussed examples also there. Correct? Restaurant service works contract are classified as supply of services. Right? Those are some of the points that we discussed in schedule 2. Along with that, in schedule 2, one important aspect that we discussed was with regard to building classification. Land always comes under schedule 3, sale of land. Whereas building, it is subject to para 5b of schedule 2. With regard to building, we have to see when is the consideration received. If the entire consideration received, the entire consideration is received after the cutoff date, then it is not a supply. Schedule 3, it goes to. Whereas even if part consideration is received, even if part consideration is received before the cutoff date, then it would be considered as supply of services. What is this cutoff date? Cutoff date would be the date of issuance of completion certificate or date of first occupation, whichever is earlier. Correct? Yes, that is the cutoff date. This is with regard to building to be classified as a supply of service or not a supply, schedule 3. Then we discussed about 7.2, which talks about supply excludes those mentioned under schedule 3. So in these supplies, in these transactions, even though all the 3 parameters satisfy, they are not deemed to be a supply. They are not a supply. We had their services performed by an employee to employer in the course of employment for which they receive salary. Then we discussed about services provided by a court, tribunal. When it comes to tribunal, not all tribunals are covered, only those tribunals which are established by law. Then functions performed by those MPs, MLAs, persons holding constitutional post, all those come under exemption. Then services of funeral, burial, including transportation of deceased. And then sale of land subject to para 5b of schedule to sale of building. Actionable claims other than specified actionable claims. So specified actionable claims comes under supply. They are not excluded. They are not there in schedule 3. They are not excluded. So what are the specified actionable claims? There are 6 actionable claims notified. Lottery, betting, gambling, horse racing, casinos, and online money gaming. Correct. Those are the 6. Along with that, we also discussed about merchant trading, where you are purchasing and selling the goods without bringing the goods in India from one country to another outside India. That is merchant trading, not a supply. Inbound sales, when you are selling the goods when it is in the warehouse, where our goods are stored in the warehouse after importing. Then high sea sales, before it reaches the Indian waters, Indian territorial waters or Indian land, you are selling it before that. That is high sea sales. All those are not a supply. They are excluded. Along with that, 2 more new additional entries that have happened in the last 1 year. Apportionment of co-insurance premium between the main insurer and the co-insurer. And second one, services by reinsurer. Sorry, services by the insurer to the reinsurer. Insurer to the reinsurer in case of reinsurance. So co-insurance and reinsurance related couple of points, just in case if they ask. So that is about supply, section 7. Then we went on to section 8. Section 8 spoke about 2 things: composite supply and mixed supply. Correct. For we to check section 8, 2 conditions have to be satisfied. One, it should be a combination of supply of goods or services, or both. More than one, right? Combination of more than one goods or services, or both. There should be a single consideration for it. If that is the case, then I have to see whether they are naturally bundled and if there is any principal supply identifiable among them. If these 2 conditions are satisfied, then it is composite. If not, if any of those 2 conditions not satisfied, if they're not naturally bundled or no principal supply, then it has to be mixed supply. If it is a composite supply, tax rate applicable to principal supply will be applied. If it is a mixed supply, highest rate of tax among them would be applied. Right? This is the discussion with regard to composite and mixed supply. Coming to the next aspect, there is one new circular that was introduced recently, again, which we have already discussed in the regular class: treatment of vouchers. Right? For September exams, yes, that is still there, wherein 12/4 and 13/4 time of supply of vouchers is still there. In relation to vouchers, there is a circular which says vouchers are not supplies. Dealing in vouchers are not supplies. Only the original supply, wherein using vouchers, if you purchase something or you avail of any services, only that will be taxable. Issuance of voucher will not be considered as supply. Why? If the vouchers are considered to be prepaid instruments as per RBI, if RBI recognizes them as prepaid instruments, then they are considered as money. Therefore, they are neither goods nor services. If they are not recognized as prepaid instruments, what are we doing? Using that voucher, I am availing some service. So with that voucher gives me some claim. Therefore, if they are not prepaid instruments, then they are considered to be actionable claims. If they are actionable claims, it will be a supply only when they are specified actionable claims. Vouchers are neither of those 6 specified actionable claims. Therefore, Schedule 3 comes into picture. Okay, so either way, either it is not a supply of goods or services, or it is a Schedule 3 transaction. Therefore, no, it's not taxable. However, the supply which is made using a voucher, purchase or availing of any service, that would be taxable. Following?
Yes, sir.
Yes. So that is about the first chapter, supply. Okay, with that, we went on to the next chapter, charge, which is a charging section under GST.
9.
Section 9, yes. Section 9 again has 5 subsections. 9 subsection 1 talks about forward charge. Correct. It says tax on all outward supplies, intrastate it says because it is CGST Act. So you have to charge CGST and yes, GST. What is the maximum rate of tax allowed under 9(1)? 20% for CGST, 40% for IGST. However, it says other than for supply of alcoholic liquor for human consumption, right? So that is excluded under 9(1). Then coming to 9(2), we have petroleum products. It says once it is notified by central government upon the recommendation of council, it comes under the discussion of GST. Subsection 3 talks about RCM, notified supplies. Right, there are two notifications, one for goods and one for services. Goods are not so important for us, maybe related to metal scrap they might ask, not too sure about it, but since it's a reasonably new provision, metal scrap supplier should be, if supplier is RCM, right? Yeah, supplier is unregistered, recipient is registered, then it comes under RCM. Whereas with regard to services, there are multiple entries in that notification which are important for us, which we'll look into it. 9(4) talks about again RCM. These are notified suppliers, notified suppliers and notified supplies. Okay, so it's not only recipient specific, not only supply specific. If it is provided by such supplier or received by such recipient, it comes under the discussion. For our understanding, we have that one discussion on real estate sector, which I'll come upon with regard to 9(4). And 9(5) talks about e-commerce operators, notified supplies. What are the notified supplies given under this? There are 5 supplies. First one, transportation of passengers through e-commerce operators. This has 2 discussions. Right? This has 2 discussions. Supplier is using omnibus. Supplier is doing it other than omnibus vehicle. If he is using other than omnibus, always 9(5). If he is using omnibus, 9(5) only if supplier is
Body corporate.
supplier is company, not body corporate here. Supplier is company, forward charge 9(1). Supplier is other than company, then comes under 9(5). Okay, that is with regard to transportation of passengers. Then second one is in relation to accommodation service. Third one, housekeeping service. For these 2, the condition is supplier should be not liable to register. Only if supplier is not liable to register, it comes under 9(5). If supplier is liable to register, outside the scope of 9(5). Whereas last one is restaurant service. In relation to restaurant service, there are 2 things. If you are providing it in a premise which is considered to be specified premise, then no 9(5), forward charge. If it is other than specified premise, then 9(5) comes into picture. So definition of specified premises say it has to be the room accommodation charges in that particular premise is greater than 7,500 per day per unit, then it is considered to be specified premise. Any accommodation there, then it considered to be specified premise. Now that specified premise definition has been expanded with effect from 1st of April 2025, which says even if you can voluntarily declare yourselves as a specified premise, even though you do not have any accommodation service more than 7,500 per day, or you don't have any accommodation service also, even still in that case, you can voluntarily declare yourselves as a specified premise. So if you are a specified premise, forward charge. If not, 9(5) comes into picture. Okay, these are the discussions under 9(5). Coming to the discussion on 9(3), this is what we have to focus on now. RCM related, few important discussions there. First one, as we always discuss, GTA. With regard to GTA, combining our discussion of what we have learned in exemptions and what we have learned in RCM, we have to see what type of goods it is. If the GTA is transporting specified goods, what are those specified goods? In exemption we had discussed? It could be organic manure, it could be defense material, relief materials, newspapers, All right, all those discussions, then it is always exempt, irrespective of who is the recipient. If it is other than specified goods, if it is other than specified goods, then I have to see who is the recipient. If the recipient is registered, if recipient is registered, one of the specified person is a person registered under GST, under RCM discussion. However, if the recipient is registered, he can have regular registration or he can have only TDS registration. If they have only TDS registrations, those government departments, etc., it is exempt. If they have regular registration, it is taxable. Similarly, if the recipient is unregistered, then I have to see again who is the recipient. Is he a specified person? Specified person means factory, society, cooperative societies, body corporate, partnership firm, whether registered or not, all those discussion, it is taxable. If they are not a specified person, then it is exempt. When I say it is taxable, if supplier opts for FCM, then it is forward charge mechanism. They'll have two rates, 12% with ITC, 5% without ITC. If not, if supplier doesn't opt for FCM, then it comes under RCM, 5% is the tax that we have to pay. Correct? This is about GTA. Whereas the next discussion that we had or that we have to discuss is with regard to legal services. In relation to legal services, again we have discussed three things there. Services provided by arbitral tribunal, services provided by an individual advocate or firm of advocates, services provided by senior advocates. These three, if they are providing the services to other than business entity, whose turnover in the preceding financial year is up to the threshold for registration, then central government, state government, union territory, local authority, governmental authority and government entity, then it is exempt. Along with that, this individual or firm of advocates, if they are providing services to another individual or firm of advocates, even that comes under exemption. So what is taxable then? What is taxable under RCM? Services provided these people to a business entity whose turnover exceeds the threshold limit in the preceding financial year. Registration status irrelevant there. We have to check turnover of such entity in the preceding financial year, whether it is within the threshold or exceeding the threshold. Similarly, sponsorship service, important discussion, because there is an amendment. There is a chance that in September there could be a question on this. Here now we have to see who is the supplier also. It is supplier specific also now. If supplier is body corporate, forward charge. If supplier is other than body corporate, then I have to see who is recipient. Recipient is body corporate or partnership firm. Then RCM. Other than that, then it would come under forward charge. Okay, definitely there could be a question on this. Very, very important. Sponsorship. Then services provided by government, central government, state government, union territory and local authority. In relation to services provided by government, CG, SG, UT and LA, we can divide them into three different categories. One, services by Department of Post, Ministry of Railways or Indian Railways. Service in relation to aircraft or vessel, whether within the precincts of an airport or a port or not. Transportation of goods or passengers. All these always come under forward charge. Then renting of immovable property. Then we have to, for renting of immovable property, we have two things. One, if who is the recipient, I have to check. If the recipient is registered, here registration status is relevant. If recipient is registered RCM, recipient is unregistered FCM. Then all other services, I have to see to whom it is provided. If it is provided to a business entity, if it is provided to other than business entity, if it is other than business entity, exempt. If it is a business entity, then I have to see the turnover of the business entity. Turnover of the business entity is exceeding the threshold. Turnover of the business entity is within the threshold. If it is within the threshold, exempt. If it is exceeding the threshold, then I have to see what is the consideration. Consideration charged is greater than rupees 5,000 per annum. Consideration charged is up to rupees 5,000 per annum. If it is up to rupees 5,000 per annum, exempt. If it is greater than 5,000 per annum, comes under RCM. This is with regard to services provided by a central government, state government, union territory, and local authority. Then we discussed one more important aspect for our examination point of view, which is rental. Renting of immovable property. We can divide that renting of immovable property into two things. One, residential dwelling. Second one, other than residential dwelling, non-residential, that is commercial. If it is residential dwelling, supplier is irrelevant there. I have to just see who is the recipient. If recipient is registered, then 99% case it comes under RCM. If recipient is unregistered, it is exempt. Why I said 99%? If proprietor takes it for
Personal stay.
personal stay, yes, personal stay, then it is exempt, even though the proprietor is registered. Whereas other than residential property, this is supplier specific as well. Supplier is registered, then I need not see who is the recipient. It is always under FCM. If supplier is unregistered, then I have to see who is the recipient. If recipient is registered, comes under RCM. Recipient also is unregistered. Naturally, it is not leviable to tax because it is provided by a non-taxable person. Okay, this is about renting of immovable property. Then one more point that we discussed was with regard to remuneration to directors. Services provided by director to the company in which he is a director in the capacity as a director. The word in the capacity as a director is important. If he is providing in any other capacity, no RCM. And in the capacity as a director also, if he is an employee receiving salary where TDS is made under 192, then schedule 3 comes into picture, no RCM. If he is receiving it as other than salary, it could be sitting fees, it could be remuneration, right? All those cases where TDS is made under 194J, then RCM comes into picture. That is about remuneration to director. Then we discussed about copyrights, right to use. Two things. One, with regard to music composer, photographer, or artist, right? Providing service to a music company, producer, etc. Always under RCM. Giving the right to use their work, original work. Whereas in case of an author, if he is giving the right to publish to an publisher, in that case, if author has opted for FCM, then FCM comes into picture, else RCM. Similar to GTA. Okay, option given to the author. Then we discussed about DSA, direct selling agents, providing services to banks, NBFCs. If DSA is a body corporate partnership firm or an LLP, then it is forward charge. If DSA is others like individual, HUF, etc., then it comes under RCM. Then couple of important discussions. Security services. In relation to security service, again, this is both supplier and recipient specific. Supplier is body corporate. then it comes under forward charge. Supplier is other than body corporate, then I have to see who is the recipient. Recipient is registered, then it comes under RCM. Recipient is unregistered, forward charge. So the combination here is body corporate and registered, supplier and recipient. Right? Whereas the next discussion that we have is with regard to renting of motor vehicle. In relation to renting of motor vehicle, also we have supplier and recipient specific. First thing, it is not passenger transportation service, it is renting of motor vehicle service. There's a thin line of difference there, and cost of the fuel should be part of the consideration itself. Right? Then it will be considered under this particular discussion, renting of motor vehicle. Here, supplier should be other than body corporate. So supplier is body corporate, FCM. If supplier is other than body corporate, then I have to see who is the recipient. If recipient is a body corporate, then RCM. If recipient is other than body corporate, FCM. So difference here is, in security service, it is body corporate and registered person combination. In renting of motor vehicle, body corporate and body corporate combination. With regard to security services, here we have couple of exemption. One, if they only have TDS registration, government departments, etc., no RCM. Second, composition dealers, no RCM. Same way, in renting as well, here, this registered person, if he is a composition dealer, then no RCM. There is a new entry, I think it's first time applicable for September exam. No composition exemption, composition dealer exemption. Right? Other than composition dealer, then no RCM. RCM applies only for other than composition dealers. Okay, these are some of the important discussions with regard to RCM. With that, we discussed about classification under charge provisions, classification, that is HSN and SAC, so goods and services. Why it is important? Because to determine the rate of tax. Then with regard to the concessional rate of tax in relation to real estate sector, that is where we have 9.4 discussion. Real estate sector, we can divide that discussion into two parts. First one is affordable housing, other than affordable housing. Second part, right? Other than affordable housing, including commercial shops inside residential projects where the total carpet area of such commercial shops is not greater than 15% of the total carpet area. Though all those are covered under this classification. If it is affordable housing, what do we consider as affordable housing? Affordable housing, if it is in metro cities, up to 60 square meters, non-metro, up to 90 square meters, the area of that property, value being up to 45 lakhs. Then it is considered to be affordable housing, then 1% is the tax rate. If it is other than affordable housing and commercial shops, 5% is the tax rate. However, this comes with conditions. First condition, no ITC. Second condition, out of the purchases that you have made, 80% of the purchases should be from registered persons. 80% of the purchases should be from B2B, registered persons. If there is a shortfall in the purchases of 80%, such a shortfall should be paid under
RCM.
RCM. Yes, this is what is notified under 9.4. Right? This is what the real estate sector related discussion that we had. Correct? That was about the main provisions of charge. In that chapter, we had one more section, section 10, composition levy. In relation to composition levy, what did we discuss? We had two discussions there, subsection 1 and subsection 2, which is applicable for manufacturers of goods. Others, that is traders in goods and restaurant service. Whereas 10.2a applicable to other services, basically other than 10.1 and 10.2. 10.1 and 10.2 can be applicable only if you are eligible, only if your aggregate turnover in the preceding financial year is up to rupees 1.5 crore. If it is those 8 special category states, then it is 75 lakhs. 8 special category states, UN sat M cube. Uttarakhand, Nagaland, Sikkim, Arunachal Pradesh, Tripura, Meghalaya, Mizoram and Manipur. So in such cases it is 75 lakhs. Whereas here aggregate turnover is 50 lakh in case of services. If you are eligible, then the tax rate that you pay for manufacturer, it is 1% of the turnover in the state or union territory. For trader, it is 1% of taxable turnover in the state or union territory. That's the difference. Turnover and taxable turnover. For restaurant, it is 5% of the turnover in the state or union territory. For 10-2A, it is 6% of the turnover in the state or union territory. Aggregate turnover definition also we discussed. Taxable supplies, exempt supplies, zero rated supplies, including exports, that is interstate supplies, including supplies between distinct persons, but it excludes inward supply liable for RCM and GST taxes. For the purposes of composition levy, further aggregate turnover should exclude interest income, which is exempt. Correct? Interest income, which is exempt. Yes. We also discussed about ineligible cases, which are more or less common for both. Ineligible cases, that is, even if your turnover is within the limit, you are ineligible. We have interstate supplies. If you are making interstate supplies, you are an e-commerce operator, supplying through e-commerce operator, manufacturer of some notified items, fly ash bricks, ice creams, pan masala, all those things. Then CTP, NRTP, and additionally for 10.1 and 10.2, supplier of service. Whereas for 10.2A, we don't have the last point. These points as it is come under ineligibility. So even though supplier of service is ineligible under 10.1 and 2A, they can do 10.1 and 10.2, they can do some small amount of services. We call it marginal supply of service, marginal value of service. That value is 10% of the turnover in the state or union territory in the preceding financial year, or rupees 5 lakhs, whichever is higher. However, here this service value should exclude interest income. So that is over and above. Interest income should be excluded here also. Aggregate turnover discussion as well. Okay, this completes our discussion on charge. With that, we went on to IGST Act. What was the next chapter that we discussed? Place of supply. In place of supply, we have two discussions, two classifications rather. Place of supply of goods, place of supply of services. In relation to goods, we have two sections, section 10 and section 11. This is within India. This is export and import. Services, we have section 12 and section 13. Section 12, where both recipient and supplier are in India, both are in India. Section 13 applies when either of them are outside India. Either of them, that is supplier or recipient, is outside India. Then I have to apply section 13. So what does section 10 tell us in relation to goods? So we have mainly because of now 10.1 CA applicability, we will have B2B and B2C discussion. If it is B2B, I'll check whether there is movement of goods. If there is movement of goods, location where the movement terminates. In other cases where there is no movement of goods, location at the time of delivery or making it available. Whereas in case of B2C, we have to see whether address of the recipient is mentioned in the invoice or address of the recipient is available. When I say address of the recipient is available, even state name is sufficient. Right? This is important. 10.1 CA. Even if state name is sufficient, that overrides the entire provision of section 10, right? For B2C. So in that case, such location of the recipient. If address of the recipient is not available, then go with location of supplier. Whereas we are in relation to these discussions, we have further, if it is bill to ship to. If it is bill to ship to, the original supply Place of supply will be the location of the third person upon whose instructions the supplier delivered it to the recipient. Location of the third person. Whereas if it is supply involving installation or assembly, place where such installation or assembly is done. Whereas in case of goods supplied on board a conveyance, then location where such goods were taken on board the conveyance. Right? These are the main discussions that we have in relation to goods. That is section 10. Section 11 tells us with regard to imports and exports, in case of import of goods, location of importer in India, because goods are coming into India. In case of export, since the goods are moving out of India, location outside India where it is going out. That would be the place of supply. Section 12 talks about place of supply of services, which is applicable in case of where both supplier and recipient are in India. First, we have default rule 12 subsection 2, which is applicable when any of the specific rules doesn't apply. Default rule classifies it into B2B, B2C. B2B always location of recipient. B2C, if location of the recipient is available, address of the recipient available, then recipient address. If address not available, then location of supplier. Coming to specific rules, the first one that we have is anything related to immovable property. It says services in relation to immovable property will always be location of the immovable property. However, if such immovable property is located outside India, then it is location of the recipient. Right? Whereas under section 13 also we have this immovable property. There it is always location of immovable property. Whether the immovable property is located outside India or in India doesn't matter. Always location of immovable property. That's the difference between 12 and 13 in relation to immovable property. We also discussed about what happens if the immovable property is located in multiple states. Go with the contract or agreement. Else we have scenarios. Right? If multiple immovable property is located in multiple states, single immovable property located in multiple states, or houseboat, time spent in case of houseboat. Then we discussed about performance based. In relation to performance based, we have two types rather. We have restaurant, catering, fitness, beauty treatment, cosmetic and plastic surgery, etc. It is place where such service is performed. Where it is performed. Whereas in case of training and performance appraisal, in case of training and performance appraisal, I have to see two things, B2B, B2C. If it is B2B, location of recipient. If it is B2C, then place where the service is performed. Same, this discussion. That is performance based. Similarly, we have event based. Under event based, we have two types of services, event admission, event organization. In relation to event admission, always it is place where the event is held. In case of event organization, we have B2B, B2C. If it is B2B, then it is location of recipient. If it is B2C, it goes to location, place where the event is held. However, if the event is held outside India, then location of recipient. Same way, we also have in this case, where event is held in multiple states or union territory, go with the contract. If there is no contract, then as per generally accepted accounting principles, reasonable basis. That's what the rule says with regard to event based. After event based, what did we discuss? The next discussion that we had with regard to if we have service on board a conveyance. Service on board a conveyance, then it would be the location. It's not the location where that person boarded the conveyance. No. It is first scheduled point of departure of the conveyance. Then we discussed about telecommunication. In case of telecommunication, we had multiple discussions. What if it is a fixed lines? If it is fixed line location where such devices installed, landlines, etc., antennas. Whereas in case of wireless communication, we'll have postpaid and prepaid. If it is postpaid, if address is available, then so billing address is available, such billing address. If billing address is not available, location of supplier. If it is prepaid, where is the recharge done? If the recharge is done through a selling agent, address of such selling agent. If recharge is done by any other person, then location where such prepayment is received. In case you do the recharge yourselves online, then location of the recipient in the records of the supplier. These are the provisions which comes into picture in case of telecommunication. In case of banking companies, normally it is location of recipient if location of recipient records is available. If location of recipient records is not available with the banking company, then location of supplier. Same way, insurance company, if it is B2B, location of recipient. If it is B2C, location of recipient in the records of the supplier. Similarly, we discussed about advertisement service to central government, state government. Those go with the contract. If contract or agreement is not available, on various basis where the advertisement is given, television channels, internet, messaging services, right? It could be through hoardings on trains, railway tickets, utility bills, radio channels, all those multiple discussions that we had. Then we also discussed about goods transportation. In relation to goods transportation service, B2B, B2C. If it is B2B, location of recipient. If it is B2C, location where the goods are handed over for transportation. Then passenger transportation service. Passenger transportation service will have two discussions. One is pure passenger transportation. One is right of passage, that metro card that we take and recharge. So, in case of pure passenger transportation service, B2B, location of recipient, B2C, place where such passenger embarks the conveyance for a continuous journey. Whereas right of passage, our default rule under 12.2 applies. Location of recipient available, location of recipient not available. Okay, that is with regard to passenger transportation service. These are the important points, important discussions that we have in section 12. Then with regard to section 13, more or less it remains the same, the different services that we discuss. Here, couple of important points that we have is intermediary service. Who is an intermediary? Basically, he's an agent. On behalf of another supplier or recipient, he's acting. That intermediary should be in India. Intermediary should be in India to be considered under section 13. In case of intermediary, it says the location of intermediary becomes the place of supply, whereas in case of OIDAR service, it says location of recipient. Now, what is OIDAR service? Again, we had discussed there should be presence of or requirement of information technology, internet. Using internet only if that service is to be provided. Without internet, if that service cannot be provided, then it's OIDAR. This comes into picture if supplier is outside India, recipient in India, then we have to look into that particular provision. We have a separate provision for intermediary service under IGST Act, section 14. Separate provision for online money gaming, section 14A of IGST Act, which talks about how it should be taxed. OIDAR service provider, if the recipient in India is registered, it comes under RCM. If recipient in India is unregistered, OIDAR service provider has to pay the tax compulsorily. Right? Compulsory registration comes into picture. Whereas online money gaming, irrespective of whether the recipient in India is registered or not, online money gaming service provider only has to pay the tax under FCM. So they will come under compulsory registration with regard to online money gaming. Okay, these are the main points that we discussed there. There are few incidental points also in relation to that discussion. With the place of supply, we went on to time of supply discussion. In time of supply, mainly two provisions. Section 12 of CGST Act talks about time of supply of goods. Section 13 of CGST Act talks about time of supply of services. Section 12 has multiple discussions. 12.2 talks about FCM. In relation to goods, it is due date of invoice or due date of issuance of invoice, whichever is earlier. Correct? We don't bother about the date of receipt because we have exemption on advance payment in case of goods. Advance exemption is not applicable in case of specified actionable claims. Specified actionable claims, even though they come under FCM, no exemption. In case of composition dealers, no exemption. And obviously in case of RCM, because this exemption applies only in case of forward charge. So here we discuss what is the due date of issuance of invoice. What is the due date? If there is movement of goods, on or before movement of goods. If there is no movement, that is other cases, date on which it is made available to the recipient. If it is a continuous supply of goods, date of periodical statement or date of periodical payment. In cases of sale on approval basis, date of supply, 6 months from the date of removal, whichever is earlier. Right? These are the due dates that are applicable for FCM. Similarly, in case of services also we have subsection 2 FCM itself. Here we look into whether invoice is issued within the due date or not. Invoice is issued within the due date, then we go with date of invoice or date of payment, date of receipt of payment rather, whichever is earlier. If not within the due date, then instead of invoice we go back date of provision of service or date of receipt of payment, whichever is earlier. Now, with regard to this, what is the due date that we have to focus on? Due date in case of service normally is 30 days from the completion of service. In case of banking company, financial institution, NBFC and insurance companies, 45 days from the completion of service. In case of banking company, financial institution, NBFC, insurance companies, telecom operators, if they are supplying to distinct persons, then it is end of the quarter. In case of continuous supply of services, if due date of payment is ascertainable, such due date. If due date of payment is not ascertainable, date of making the payment. In case of milestone based completion, then completion upon completion of such milestone. Right, these are the due dates. When I say date of receipt, what is the date of receipt? Date on which such receipt is recorded in the books. Date on which receipt is credited to bank account. Credited to bank account, whichever is earlier. Right, that is what with regard to forward charge we have. Then subsection 3 talks about RCM. In case of goods, we have 4 things to be discussed. Date of receipt of goods, date on which payment is recorded in books, date on which payment is debited in bank account, or 31st day from the date of invoice, whichever is earliest. Whereas in case of services RCM, it will be 3 discussions. Date of receipt of service is not there. Payment recorded in the books, payment debited in the bank account, or 61st day from the date of invoice. However, one more important point for us from this examination, if it is self-invoice, in case of RCM, if supplier is unregistered, you being a recipient has issued a self-invoice, then the time of supply there, this categorization, instead of 61st day, you have to consider it as date of invoice, whichever is earlier. What is the due date for issuance of self-invoice? Rule 47A tells us it is 30 days from the completion of service. For issuance of self-invoice, also it is 37 days. Okay, so this is about RCM discussion. Then subsection 4 talk about vouchers, which is common for both goods and services. General voucher, date of redemption of voucher, specific voucher, date of issuance of voucher. Fifth one is residual cases. In case of residual case, we have to see whether returns are to be filed. If returns are to be filed, due date of filing the returns. If returns are not to be filed, date of payment of tax. Last one, addition in value. In case of addition in value in the form of interest, late fee, etc. for delayed payment of consideration, it goes with date of realization of such addition in value, date of receipt. Here, along with section 12 and 13, we also discussed one more provision, that is section 14, which talks about change in the rate of tax. When there is change in the rate of tax in between the supply, whether I have to apply old rate or new rate, that depends on 3 things. We have to compare 3 things. Supply of goods or service. What is the date of supply? Date on which you made such delivery of goods or provision of service. Date of receipt. The date on which you received the money. Date of invoice. Out of these 3, if in which date or from the cutoff date, you will have a cutoff date, that is the date on which rates changed. In which before or after, if you have 2. If you have 2 of these events before the change in rate, old rate is applicable. If 2 of these things are there after the change in rate, new rate is applicable. Okay, that's how section 14, that is change in the rate of tax, applies. That's about time of supply. Okay, apart from time of supply, section 14, what did we discuss? We went on to section 15. Everyone following?
Yes, sir.
Yes, sir.
Section 15 talks about value of supply. In relation to value of supply, what did we discuss? Two things. First, section 15(1) says two conditions to be satisfied. If price is the sole consideration and supply between unrelated persons. If these two conditions are satisfied, value of supply will be 15(1) plus 15(2) minus 15(3). What is 15(1)? Transaction value. What do we understand by transaction value? Amount charged or paid or payable for such supply. That is itself is transaction value, to which we have to add certain items. Addition. What are those additions? We discussed taxes other than GST, if they are collected separately from the recipient, municipal tax, purchase related taxes, whatever it is. Similarly, payment of the supplier in relation to such supply made by the recipient. Then incidental expenses in relation to the supply, packing, transportation, all those incidental expenses I should add if it is incurred up to the time of completion of supply. Once supply is completed, it's not my responsibility. Those things should not be added. Then we have subsidies. In relation to subsidy, we have two things. Such subsidy should be price linked. If it is other than price linked, ad hoc subsidy given, then not to be added. If it is price linked subsidy, then I have to see from whom we have received it. If we have received it from central government, state government, not to be added. If it is received from others, added to the provisions. Normally in the examination, they would give us, once they have given subsidy information, they'll give the list price of the goods is after considering that subsidy. After considering that subsidy means they have reduced it from the value of goods. Okay, so if they have reduced it, if it is central government, state government, we should not do anything. If it is others, we should add it. That is with regard to subsidy. Then addition in value in the form of interest or late fee. Right? Addition in case of delayed payment of consideration. All those things have to be added. That leads us to discount 15(3). In relation to 15(3) discount, we have two types of discounts. Discount given at the time of supply. At the time of supply, discounts given after supply, post-supply discounts. Discounts given at the time of supply should be reduced from the value of supply if it is shown on the invoice. Right? If shown on the invoice, we will have to reduce it. Post-supply discounts will be reduced only if three conditions are satisfied. Terms of such discount was established at the time of supply. That means they knew that we had to give a discount at the time of supply. Second, such discounts can be calculated, can be worked out invoice wise. 3, recipient reverses proportionate ITC. Recipient reverses proportionate ITC. If these things are there, then I will reduce it from the value of supply by issuing a credit note. If not, in case of secondary discounts, I cannot reduce it. In such cases, I will issue for the purposes of accounts, financial or commercial credit note. Whereas if price is not the sole consideration or supply between related parties, then 15(4) says you have to go to the rules. Or in some cases of notified supplies, 15(5) says we have some specific modes of valuation. So in relation to those two conditions not satisfied, we have rule 27, which talks about where price is not the consideration, where the consideration is not wholly in money. If consideration is not wholly in money, then I have to go with open market value. If open market value is not available, whatever monetary consideration you have plus equivalent monetary value of non-monetary consideration. Equivalent value of non-monetary consideration. So you have to evaluate. Or if that is also not possible, go with value of like, kind and quality. Like, kind and quality. If that is also not possible, rule 30 and rule 31. That is where price is not the sole consideration. Rule 28 talks about related party distinct persons other than agent. related party distinct persons. In case of related party distinct persons, first you have to go with open market value. Second, skip the second step. Value of like, kind and quality. Here, directly go to the third. If that is also not possible, rule 30, 31. That is in case of rule 28. In case of rule 29, it talks about agents. Supplying through agent. How will we determine? Rule 29 says same open market value. However, instead of open market value, you can also choose 90% of like, kind and quality instead of open market value. So if the agent sells it to the customer at 100 rupees, principal can value it at 90 rupees. 90% of like and quality, open market value or 90%, or you can go with rule 30, 31 if that is not possible. So what is this rule 30 and rule 31 talking about? Rule 30 talks about 110% of cost. Cost of production, 110%. Rule 31 talks about best judgment, reasonable basis based on the facts available. In case of services, you can bypass rule 30 and directly go to rule 31. Else, normally you have to go to rule 30 and then only rule 31. But in case of services, you can bypass the same. Apart from these are based on 15.4. These two conditions, not satisfied cases. Apart from these, there are some notified supplies. We have rule 31A, which talks about lottery, betting, gambling, and horse racing. Those four specified actionable claims. There, we have two discussions. In case of lottery, it would be 100 divided by 128 gross up of face value of the lottery, or 100 divided by 128 of price notified by the government. Notified price, whichever is higher. In case of other three, gambling, betting, or horse racing, it would be 100% of face value. Same. See, it's ultimately the same, but instead of 1 by 120, 100 by 128, we're just taking 100% net value. No grossing up is done here. 100% of the face value or actual amount paid by you. Amount paid for participating in that bet or gambling, whatever it is, whichever is higher. That is rule 31A. Then rule 31B talks about online money gaming. In case of online money gaming, whatever amount you pay, the total amount paid is considered to be the consideration. That is value of supply. Similarly, rule 31C talks about casinos. Whatever amount you pay for participating, for purchasing tokens or participating in any games, whatever amount paid itself will be considered as value of supply. Apart from this, rule 32 gives us certain specific supplies. This is an option given to the supplier. He can, instead of going with transaction value, he can come to this. In that first one, we have is conversion of foreign currency. In case of conversion of foreign currency, we have two things, two options rather. One, if you have RBI reference rate, etc., buying rate or selling rate, that is actual transaction rate, minus RBI reference rate will give you the premium that you have received, that multiplied by number of units converted, number of units of currency. That gives us the value of supply. Right? If such RBI reference rate is not available, INR, value of INR into 1% also can be considered. Whereas another one is slab based. If the amount on INR after conversion is up to rupees 1 lakh. If it is up to rupees 1 lakh, then 1% of the value or rupees 250, whichever is higher. If it is from 1 lakh to 10 lakhs conversion value, then it is rupees 1000 plus 1% will become half, 0.5% of the value in excess of 1 lakh. Then 10 lakh to, sorry, above 10 lakh, 5,500 rupees plus 0.1% of the value in excess of 10 lakh, or rupees 60,000, whichever is less. Okay, this is very, very important. Conversion of foreign currency. Normally, they have asked multiple times. They have asked in the exams valuation of this. Okay, both either of this they can ask. So be careful with regard to that. Then that was foreign currency conversion. Then we have service in relation to booking air tickets. In relation to booking air tickets, this is not passenger transportation. This is commission that the air ticket agent receives on that. If it is domestic, 5% of the basic fare. If it is international, 10% of the basic fare. Then in case of life insurance, this is also important. Life insurance, multiple times they have asked. Well, life insurance policies are divided into 3 categories. First is if amount allocated for investment is available, intimated. Amount allocated for investment is intimated. Then premium received minus allocation for investment, whatever is allocated. So basically, principle here is only pure risk relation to that insurance should be taxed. If it is related to investment, investment is money, securities will not come under supply. So allocated for investment you reduce, the balance will be taxable. However, if it is a single premium annuity, where annuity is paid upfront, huge amount, then 10% of the single premium paid will be considered as the value of supply. In other cases, that is, if it is not a single premium and amount allocated for investment is not known, in such cases, if it is first year, the insurance agent gets more. So 25% of the premium. In the subsequent years, half, 12.5% of the premium. Whereas one more category we have, if it is pure life insurance, term insurance, etc., then entire premium is the value of supply. Okay, that is about what is a life insurance business. Then we also discussed about margin scheme. What is margin scheme? Sale of second-hand goods. In case of margin scheme, the condition here is second-hand goods, no further processing you are doing, you are just purchasing and selling it. No ITC is allowed. In that case, value of supply is selling price minus purchase price, only that margin. If that is negative, that is you are selling at a rate lesser than the purchase price, negative should be ignored. However, in relation to this margin scheme, we have sale of old motor vehicles, used motor vehicles. In relation to that, since motor vehicle is blocked, if ITC is not available, you have not claimed the ITC, then go with the normal valuation. Normal valuation is, sorry, where ITC is claimed, go with the normal valuation. Since you have claimed the ITC, go with the normal valuation. If ITC is not claimed, then you have to come to this. ITC is not claimed, then you have to come to this margin based. However, this is fixed asset, you would have claimed depreciation. If depreciation under Income Tax Act is claimed, then selling price, instead of taking the purchase price, take depreciated value as per Income Tax Act, that is WDV. Depreciation under, if not claimed, if there is no depreciation under Income Tax Act, then selling price minus purchase price actual would be the value of supply. In case of token, vouchers, coupons, stamp, etc., it's the redeemable value itself, the value of supply. Then we went on to one more important aspect, Rule 33, pure agent. If you are acting as a pure agent, then the value of supply is considered to be nil. What is pure agent? You're not, it's not for you. You are acting on behalf of another person. Invoice is issued in the name of another person. On behalf of that other person, you are incurring such expenditure. You are recovering from the other person on a cost to cost basis without anything extra. Then you are a pure agent. In case of pure agent, whatever amount you receive as reimbursement of expenses, value of supply will be nil for that. So no GST will be payable there. Then Rule 34 talks about what is the rate of exchange that we have to consider if it is in foreign currency. The rate of exchange that we have to consider, if it is goods, we have to go to CBIC rate because customs comes into picture. If it is services, go with whatever rate that you have followed in your books of account, generally accepted accounting principles. Okay, this is value of supply in relation to Rule 28. I'll just come back to previous slide. In relation to Rule 28, related persons, there is one concept which can be important, which is corporate guarantee. In case of guarantees given by related persons, there can be two types of guarantee: personal guarantee and corporate guarantee. If it is personal guarantee, value of supply is nil because RBI says you cannot charge consideration. Whereas if it is corporate guarantee, then the value of supply will be actual consideration charged, or 1% of the value of guarantee per annum, whichever is higher. That is the value of supply in case of personal guarantee and corporate guarantee. Okay, with this we went on to the next important aspect, input tax credit. In input tax credit, we have first section that we discussed, section 16. We have 6 subsections now under section 16. Subsection 1 says every registered person only can claim. So he should be a registered person. Every registered person can claim ITC. It should be in the course or furtherance of business. However, you need not have used it to claim the ITC, even if you are intending to use it in the course of furtherance of business. Intention is important as per 16.1. 16.2 talks about eligibility conditions. First one, you should have a valid tax paying document. Valid tax paying document. Second one, supplier should have filed his GSTR1 and recipient should have received it in his GSTR2B. Third one, you should have received the goods or services. In case of bill to ship to, deemed to have received it. The third person is deemed to have received it. Then next one, it talks about ITC should not have been restricted. Again, officer's power. Then next one talks about supplier should have paid the tax. To ensure supplier has paid the tax, we have Rule 37A. Rule 37A talks about you have to check whether the supplier has filed the GSTR 3B within September of the subsequent financial year. If he has filed, fair enough. If he has not filed, then ITC that you have claimed, you should reverse it within 30th November, 2 months time, without interest. If you do not reverse it within 30th November, after that reverse with interest. Subsequently, whenever the supplier files his GSTR 3B, you can reclaim it irrespective of 16.4 time limit. Then you should have filed your GSTR 3B. You can claim input tax credit only in GSTR 3B. Therefore, you should file your GSTR 3B. This has a couple of provisos. If you receive it in lots or installments, ITC can be available or claimed only upon receipt of last lot. And you should make the payment to the vendor within 180 days from the date of invoice. 180 days payment. If you do not make it, upon expiry of 180 days, you have to reverse the ITC with interest. Subsequently, whenever you make the payment, you can reclaim such ITC irrespective of 16.4 time limit. However, this requirement of 180 days is not applicable in case of RCM, in case of Schedule 1 supplies, because without consideration supplies. In case of section 15.2 addition, we have payment made by the recipient on behalf of the supplier. Payment, that is liability of the supplier met by the recipient, made by recipient on behalf of the supplier. On those 3 cases, the requirement of payment within 180 days doesn't apply. Then subsection 3 talks about if depreciation is claimed on capital goods and plant and machinery, then no ITC. Then depreciation claimed on capital goods and plant and machinery, ITC component of capital goods of plant and machinery, then no ITC. 16.4 talks about time limit, 30th November of the subsequent financial year or date of filing annual return, whichever is earlier. Then 16.5 talks about time extension of time limit to claim ITC for financial years 17-18, 18-19, 19-20, 20-21. The time limit have been extended up to 30th of November 2021. Then 16 subsection 6, this can be important for us. This is the time limit to claim ITC in case of revocation of cancellation. In case of revocation of cancellation, in that case, what is the time limit available? Go with normal 16.4 time limit or 30 days from the date of revocation. 30 days from the date of revocation, whichever is later. Whichever is later. That is what 16.5 and 16.6 talks about. Then with this, we went on to section 17. Section 17 has two parts. So first part talks about apportionment of credit. Second part talks about blocked credits. 17.5. Apportionment of credit 17.1 to 17.4. 17.1 says if they are using such ITC for business and non-business purpose, you can claim only to the extent of business purpose. 17.2 says if you are using it for exempt and taxable supplies, you can claim only to the extent of taxable supplies. So what if I'm using it commonly for both? Then you have to proportionately claim. For that purpose, we have rule 42 and 43. 42 for inputs and input services, 43 is for capital goods. 5% per quarter we have to consider and reverse it on a every quarterly basis for common credits. 17.3 defines exempt supply for this purpose. It says exempt supply includes. That means apart from whatever we know, what is exempt supply? Wholly exempt from tax, nil rated supplies, non-taxable supplies. The definition of exempt supply. Apart from that, it says you also have to include land and building, transaction in securities, supply of warehoused goods, that is inbound sales. Inbound sales. Apart from this, no other Schedule 3 items should be included. Now, when I say land and building, how should I value it? It says go with the stamp value. Stamp duty value itself will be considered as the value for exempt supply. In case of transaction of securities, it says 1% of the transaction value should be considered as the value of exempt supply. Okay, these two are important. Valuation they can ask. They can ask those two in apportionment of credits that can be asked. Whereas in case of 17.4, it is an option given to banking company, financial institutions, NBFCs. What is that? Instead of they going with rule 42, rule 43, what can they do? They can take the total ITC. From that total ITC, they will remove non-business related. They will remove blocked credits under 17.5. They will remove supplies received from distinct persons. Out of the balance remaining, don't worry about exempt, taxable, proportionate. Take 50% you claim, 50% will lapse. Now, why did we remove these three? Because these two 100% not allowed. This 100% allowed. So remove those two and those three and then balance 50%, 50% we are supposed to do. Are we clear? So rule 42, rule 43 proportionate on what basis? Based on the exempt turnover and total turnover. Based on that bifurcation would be done. This leads us to 17.5 blocked credits. Under 17.5, the first one that we discussed was motor vehicle. The point there is motor vehicle in relation to transportation of passengers. So if it is for transportation of goods, allowed. It doesn't come under this discussion. Transportation of passengers, we will divide it into two categories of motor vehicles. One, rail and special purpose vehicle used inside factories. And other motor vehicles. Under other motor vehicles, I will divide them into two-wheeler, three-wheelers, others. Under two-wheeler, three-wheeler, up to 25cc, beyond 25cc. Because these two, it is allowed. Among these two, I will see first seaters. Greater than 13-seater, including driver, up to 13-seater. If it is greater than 13-seater, again allowed. If it is up to 13-seater, I'll have to check for what purposes they are used. If they are used for taxable supplies, important, taxable supply, it should be taxable supply of further supply of such motor vehicle. Transportation of passengers, taxable supply of transportation of passengers, imparting training on driving such motor vehicle. Imparting training on driving such motor vehicle, then allowed. If it is used for other purposes, it is blocked. Same thing applies for vessels and aircraft. In case of vessel and aircraft, we will not go for those CC, will not go for number of seats, etc. Directly we'll see for what purposes they are used. If they are used for transportation of goods or taxable supplies of same these three, further supply of such vessel or aircraft, transportation of passengers, imparting training on, instead of driving they use navigating in case of vessel, flying in case of aircraft, then it is allowed. In all other cases it is blocked. Then not only this motor vehicle or aircraft or vessel, there are some services which are incidental to this. For example, insurance, general insurance, repair and maintenance and servicing service, repair and maintenance and service. Right? In such cases, we have to see whether ITC on that original vehicle is allowed. If ITC on original vehicle is allowed, let's say that vehicle was used for transportation of goods, original vehicle ITC is allowed, then ITC on such insurance, repairs and maintenance is also allowed. Then ITC is allowed. If ITC on original vehicle is blocked, in that case, we have two exceptions. One, manufacturer of motor vehicles. For him, more than it being a motor vehicle, it's a stock for him. So in stock, if he's taking insurance, yes, he can claim. Second, services provided by insurance company. If when you are claiming, making an insurance claim, if insurance company is paying the amount for the servicing, right, claims, on that GST, insurance company can claim. If it is for other purposes, it is blocked. Same way, renting, leasing, hiring of motor vehicle, vessels or aircraft. In that case also, first I have to say ITC on original vehicle. If ITC on original vehicle is allowed, then this ITC is also allowed. If ITC on original vehicle is blocked, then there are two circumstances where it is allowed. One, whether if it is used in the course of furtherance of further supply, in the sense in the same line of business, that is you are in renting or leasing service in the same line of business, or as a part of taxable composite or mixed supply, if you are using it, composite or mixed supply, or such renting or hiring you are taking as a part of statutory obligation, then it is allowed. If it is taken for other purposes, blocked. Okay, this is in relation to motor vehicles, vessels and aircraft. Then we had discussions with regard to food and beverages, outdoor catering, beauty treatment, health services, cosmetic and plastic surgery. In such cases, if it is used in the same line of business or same as renting, hiring motor vehicles, same line of business, or part of taxable composite or mixed supply, then it is allowed. Or you can also use it as a part of statutory obligation. If there is a statutory obligation also, it is allowed, including life insurance and general insurance also covered here. Health insurance, life insurance and health insurance. If it is for other purposes, it is blocked. Similarly, membership of a club, fitness centers, and LTC, leave travel concession, LTA given to employees. In those cases, it is allowed only if statutory obligation. In other cases, it is blocked. Next discussion that we had with regard to this blocked credits is construction related. Under construction related, we have two things. One, works contract. Two, construction on own account. In relation to works contract, normally it is blocked. However, we have three exceptions. One, if it is for in the course of furtherance of same line of business, that is subcontracting. Two, if it is plant and machinery. 3. If it is not capitalized in the books, then it is not considered to be construction. Construction definition says it should be capitalized in the books. Whereas if it is on own account, again it is blocked. That is, you are constructing a building. Why? For your own use, for office building, factory building, etc. Then again it has 2 exceptions. There is no concept of subcontracting here. Plant and machinery, that amendment has happened. Second, capitalized, not capitalized in the books. Now, what is this plant and machinery? That is also defined under section 17 explanation. What does plant and machinery mean? It means any apparatus, equipment or machinery which is affixed on earth. Because it has to become an immovable property. So for that, if it is affixed on earth, it includes structure, civil structure and support, foundation and support of such plant and machinery. However, it excludes 3 things: land, building or any other civil structures. Second, telecommunication towers. Third, pipelines laid outside factory. All those 3 are not plant and machinery, meaning ITC related to them is blocked. Okay, that is works contract related. Then we also discussed about inward supply from composition dealer. Anyhow, he doesn't charge us GST, so I cannot claim input tax credit. Then if you're using it for personal purpose, you cannot claim it. NRTP related, they can claim only IGST on import of goods, NRTP. Then if you are using it for CSR activities, you cannot claim it. And in case of gift, samples, goods lost, destroyed or otherwise disposed of, stolen, in those cases also, if you have already claimed, you have to reverse. If you have not claimed, you cannot claim it. That is section 17. With that, we went on to section 18. Section 18 talks about credit in certain circumstances. Right? 18 subsection 1 gave us 4 circumstances where I can claim the credit. First one, you are liable to register and applied for registration within 30 days. Second one, voluntary registration. In these 2 cases, you are eligible to claim inputs. In this case, which is there as on the date preceding the date of liable to register, in this date preceding the date of grant of registration. Composition dealer converted to taxable, regular registration, not taxable, regular registration. Exempt supply becoming taxable. In such cases, we can claim inputs as well as capital goods, but capital goods 5% per quarter should be reduced as on the date of such conversion, preceding the date of conversion. However, 18.2 says in all these cases, you can claim ITC only if the invoice date is up to 1 year previous, backward. So no ITC if invoice date is beyond 1 year. 18.3 talks about reconstitution of business. Whenever there is reconstitution of business, there will be a separate registration for the new entity. Transfer the ITC of existing entity to the new entity. 18.4 is ulta of 18.1. If you are converting from regular to composition, or you are converting from taxable to exempt, the goods became exempt. In such cases, whatever ITC that is there on such goods or capital goods, inputs and capital goods, as on the preceding date of such conversion, reverse it. Capital goods minus 5% per quarter has to be done. 18.5 talks about these rules. 18.6, which can be important for us. 18.6 talks about tax payable in case of supply of capital goods and plant and machinery, sale of fixed assets. What is the tax that you have to pay? The tax that you have to pay is tax on transaction value. Tax on transaction value under section 15. Outward supply, whatever transaction value that you get, or ITC claimed minus 5% per quarter or part thereof, whichever is higher. That is the tax that we have to pay. Okay, that is what section 18 subsection 6 talk about. Then section 19 related to job work, we'll come to it a little later. Section 20 talks about ISD, input service distributor. What does it tell us? Now it is compulsory, right? If you are receiving common service which is applicable for more than one state or union territory where you have registrations, compulsorily you have to apply for an ISD. You have to take such invoice in the name of ISD and distribute. It is applicable only for distributing input services, not inputs and capital goods. There's such ISD has to file GSTR 6. IGST will be distributed as IGST itself. CGST will be distributed if that CGST is GST. If they are in the same state as the ISD registration, they will distribute it as CGST as GST. If the other registrations are in different states, they'll distribute it as IGST. Okay, that's how they do. In what basis, in what proportion? In proportion of the state or union territory turnover. Based on the turnover, they will distribute. Okay, that's about ISD. Then we discuss about order of utilization of ITC. We know IGST first against IGST, then CGST, SGST, in any order, any proportion. CGST against CGST, and then against IGST, not against SGST. SGST against SGST, and then against IGST only if CGST credit is fully utilized, but can never be utilized against CGST. Then we discussed about restriction on utilization of credit, Rule 86A, in certain cases where in case of fake invoice, supplier not existent, recipient not existent, etc. Officer can restrict utilization of the credit claimed by you. However, such restriction can be there for a maximum of 1 year. Rule 86B talks about again restriction on utilization. This is applicable if your monthly taxable turnover exceed rupees 50 lakh. Taxable turnover means other than zero rated supply. Exceeds 50 lakh, then what is the restriction? Maximum ITC that you can utilize is 99% of your output tax liability, meaning 1% you have to pay in cash. However, this has exceptions that can be asked in the exams. First one is payment of income tax of more than rupees 1 lakh in last 2 years. Who? Either you as a registered person or your karta, any of two partners, whole-time director, managing trustees, board of trustees in case of association of persons, even if they have paid, gets covered. Refund of unutilized ITC in case of zero rated supply without payment of tax and inverted duty structure. If you have received of more than 1 lakh in the preceding financial year, then you're exempted. In the current financial year, cumulatively, if you consider from April, you have satisfied 1% output tax condition. You have already paid more than 1% in cash. Then you are covered, exempted. Then local authority, public sector undertaking, statutory corporations, government bodies, all those are exempt. Now here, when I say 1% you have to pay in output tax in cash, that has to be output tax. RCM paid in cash cannot be considered in that discussion. Okay, this is about Rule 86B. These are the main discussions that we had in relation to input tax credit. Then last discussion under the main provisions that we had was exemptions. Under exemptions, we discussed various things. Right, we started with 12AA 12AB. Services provided by 12AA 12AB registered entity by way of charitable activities, renting of religious precincts, room less than 1,000, commercial shops less than 10,000 per month, kalyana mandapam, etc. less than 10,000 per day. Then we also discussed about training in recreational activities. If it is by way of classical form of dance, etc., then it is by individual. Or sports 12AA 12AB registered entity. Then we discussed about educational institutions. We discussed that agriculture. Before that, agriculture, any process on agriculture, including cultivation of plant, rearing of animals other than horses, gets covered. Even after cultivation, if you are doing services, processes, such process also can be exempt if two conditions are satisfied. It is not altering the essential characteristic of such agricultural produce, make it marketable in the primary market. Then educational services, educational institution definition, 3 categories: preschool up to higher secondary, qualification based, approved vocational education courses, outward supply, any services made to student, faculty and staff, exempt. And admission, entrance exam related services are also exempt, outward supplies. Inward supply, first 3: transportation of student, faculty and staff, catering services, and security, housekeeping and cleaning service. Such service will be provided in the premise only. If these 3 services are eligible exemption only to category A, that is up to higher secondary. Fourth one, admission or conduct of examination to all educational institutions. Service only, again not goods. Last one, periodical online journals only to qualification based educational institutions. Right, that was about educational institution. Then we discussed about healthcare service. Definition of healthcare service says it could be care, treatment or diagnosis in relation to injury, trauma, abnormalities, all those discussions in any recognized system of medicine in India. And it includes transportation of patients to and from the clinical establishments. However, it does not include hair transplantation, cosmetic and plastic surgery. However, such hair transplantation, cosmetic and plastic surgery will also be included in healthcare service if it is in relation to rectification of congenital defect, developmental abnormalities, injury or trauma. All healthcare services provided by clinical establishment, authorized medical practitioners and paramedics are exempt. However, room charges, if it is up to 5,000 only, it is exempt. However, such monetary limit, 5,000 per day, if such monetary limit is not applicable for ICU, ICCU, NICU and CCU, emergency wards. Right? That was about healthcare service. Then other important discussions, GTA, legal service, as well as service provided by central government is covered already, right, in the RCM discussions. Then in case of performance by an artist, it should be in the classical or art form of folk form of dance, music and theater up to 1.5 lakh, not as a brand ambassador. Then resident welfare association, maintenance charges received by them per month per member up to 7,500, exemption applies. Correct. These are some of the important provisions there. Then we went on to registration chapter. In registration, two things is important when we are looking at section 22, aggregate turnover definition, which I have already discussed in composition levy, and threshold limit. Threshold limit in case of 4 states, Manipur, Mizoram, Tripura and Nagaland, always 10 lakh. If in other states, that is other 4 states which we have, that is Uttarakhand, Sikkim, Arunachal Pradesh and Meghalaya plus Telangana and Puducherry. In those cases, it is always 20 lakh. Whereas in all other states, it will be 20 lakh if they are dealer in goods or services or both. If they are exclusively dealing in goods, it is 40 lakhs. However, for that there are some exclusions also. Right? They cannot come under compulsory registrations. They cannot be supplying those notified goods that we discussed in composition levy. Those exemptions are there, rather exclusions are there, but 40 lakh limit applies in those cases. That is 22. Then we went on to 24, compulsory registration. We have list there, interstate supply. Exception is services up to threshold, notified handicraft and handmade goods up to threshold, CTP, notified handicraft and handmade goods up to threshold. Then you have e-commerce operator related. As an e-commerce operator, if you are liable to pay under 9.5, regular registration compulsory. If you are not liable to pay under 9.5, then you have to do TCS registration compulsory. As a supplier, if you are a supplier of service through e-commerce operator, up to threshold you have exemption. If you are a supplier of goods, you have exemption now. You can claim, you can supply through e-commerce operator up to threshold. However, the condition is you cannot make interstate supplies. That's the condition that we discussed. Then we also discussed about person requiring to pay RCM. If he is liable to pay under RCM compulsory, NRTP compulsory, TDS registration compulsory, agent of a taxable person. If principal is registered, taxable person, agent compulsory registration, ISD, OIDAR, online money gaming, all these comes under compulsory registration. Then 23% not liable to register. What did we discuss there? First one is if you are dealing in exclusively supplies which are wholly exempt from tax, non-taxable supplies, then you need not take registration. If you are an agriculturist, agriculturist means individual HUF only, in relation to cultivation of land, only their exemption is available. If you are a supplier who is dealing only those supplies which are taxable under RCM, then you need not take registration. Right? These were exclusive under 23. Then we discussed about the procedures for registration, 25, 26. 27 talks about CTP, NRTP, the difference between CTP and NRTP. CTP occasionally conducts business in that state. However, he has a place of business already in the another state in the country. Whereas NRTP also occasionally does business in the state, but he does not have a place of business or residence in India. They have to apply for registration 5 days prior to the commencement of business, validity of registration 90 days, or the date specified in the application, whichever is less, which can be further extended by one time of another 90 days. Advance tax have to be paid at the time of registration application itself. Right? Then there is time limits for approval of registration, 30 days, 7 working days, etc. Depending on other authentication, other cases, physical verification cases. If they do not do it, deemed approval. Then rule 10A, important for us, banking, furnishing bank details. The time limit to furnish the bank details in the portal is 30 days from the date of registration or before filing GSTR1 or IFF, whichever is earlier. Right? That is rule 10A. Then effective date of registration, if you are liable to register and if you have applied within 30 days, date of liable to register. If you have not applied within 30 days, date of grant. If you are gone for voluntary registration, date of grant of registration. Then we have amendment, core field, non-core fields, etc. and cancellation of registration by you voluntarily or by the department for certain violations. If department cancels the registration, you have an option to apply for revocation. Revocation of cancellation should be applied within 90 days of serving the cancellation order, which can be further extended by 180 days. Then we went on to tax invoice, credit note, debit note related discussions. Right, tax invoice can be issued only by a taxable person in relation to a registered person in relation to a taxable supplies. Right, details of recipient. What if it is registered? You have to give name, address, GSTIN, unregistered, value greater than or equal to 50 lakh, less than 50 lakh, those discussions. HSN, turnover up to greater than 5 crore, 6 digits, up to 5 crore, B2B 4 digits, else optional. E-invoice, applicability of e-invoices. If your turnover, aggregate turnover in any of the preceding financial year from 17-18 is more than 5 crore, then you have to issue e-invoice in relation to 3 categories of supplies: B2B supplies, exports, and 9(3). Supplies which are liable for RCM under 9(3). Those 3 cases. Exemption, SEZ unit, insurer, banking company, financial institution including MBFC, passenger transportation, GTA, multiplex, and government departments, local authorities. Those are exempt. Then we discussed about dynamic QR code. Applicability is if your aggregate turnover in the preceding financial year from 17-18, any of such financial years more than 500 crore, on all B2C supplies, there should be a dynamic QR code. Exceptions here, same for insurance, banking company, passenger transportation, GT and multiplex, plus 2 exports, and in case of OIDR service providers. Okay, these are the additional exceptions for dynamic QR code. However, if payment is made before issuance of invoice, payment terms mentioning is sufficient, dynamic QR code not required. That is about dynamic QR code. Then we discussed about revised tax invoice. What does revised tax invoice talk about? If your effective date of registration and date of grant of registration is different, during that time period, you have to issue revised tax invoice within 1 month from the grant of registration. Consolidated revised tax invoice concept also we discussed. Then consolidated tax invoice, value of goods should be less than 200. It should be B2C supplies and recipient not requiring invoice. In that case, you can issue a consolidated tax invoice end of the day, daily basis. Bill of supply is issued in case of exempt and composition dealers. Delivery challan is for any supplies other than by any movement of goods other than by way of supply, job work, etc. Credit notes and debit notes can be issued. Credit notes is erroneously if you have declared less value, erroneously declared less tax rate, erroneously you have billed lesser quantity, or you have billed higher quantities. To reduce the value, you will issue credit note. To increase the value, you will issue debit note. Books of accounts and records. Every registered person should maintain in their principal place and additional place. Till what time they have to maintain? 72 months from the filing of from the due date of annual return. In case of appeal, 1 year after the date of disposal of appeal, or 72 months, whichever is later. Period of retention is important there. Then e-way bill. Normally when e-way bill is required, when the consignment value is greater than 50,000. Consignment values including GST. However, in some cases, even if it is less than 50,000, you have to do interstate supply of handicraft, handmade goods and job work transfer interstate. In such cases, even if it is less than 50,000, it is compulsory. Then we also discussed exceptions for e-invoicing. You need not do invoice in some cases. Validity of e-invoice, e-way bill to up to 200 km 1 day. Beyond 200 km, additional 1 day, or part thereof, you'll get additional 1 day. Correct? That is normal. For ODC, it is 20 kilometers. Over dimension cargo. Then payment of tax, we discussed about cash ledger, credit ledger, liability ledger. I can use credit ledger only for payment of output to tax, only output to tax, right? Then we also discussed about in that order of discharge of taxes. First, you have to discharge self-assessed tax of the previous period, self-assessed tax of current period, and then balance demands from the department. Then interest liability, output liability. If it is you have filed the returns on a delayed basis, then interest will be calculated on the net. If you have filed the returns properly, you have missed to declare one of the invoice. If you are declaring that invoice subsequently, it's on gross basis. And then in case of input tax credit, interest is applicable only if you have wrongly utilized such ITC. Wrong utilization, only interest is applicable. And in case of payment of tax, if you have already paid the tax in electronic cash ledger but filed the returns delay, no interest to the extent of amount you have deposited already before the due date of filing such returns or payment of tax. Then TDS, TCS requirements. TDS is applicable on such notified supplies, supplies made to government, central government, state government departments, local authority, government agencies, public sector undertakings, etc. In that cases, if the contract value is more than 2.5 lakh, then they have to do TDS at 2%, CGST is raised to 1% each. However, no TDS is applicable when location of supplier and place of supply is one state, location of recipient is in another state. Correct? Then no TDS will be applicable. Coming to TCS, TCS is applicable only if it's through e-commerce operators. Under e-commerce operator, if it's coming under 9.5, no TCS. If it is not coming under 9.5, TCS. They are mutually exclusive. TCS should be made by e-commerce operator at the rate of 0.2525, that is 0.5% on the total net value of supplies in that month, and they have to file GSTR 8. That is about e-commerce. Then we went on to returns, GSTR 1, GSTR 2A, 2B, 3B, QRMP scheme. QRMP is applicable only if, rather you are eligible to opt for QRMP only if your turnover in the preceding financial year is up to rupees 5 crore. Turnover is up to rupees 5 crore. You can go for QRMP, quarterly return, monthly payment. Monthly payment, when you do, there are two methods of making the payment: fixed sum method and self-assessment method. Fixed sum is 35 in the first 2 months of the previous quarter liability. Last month, on a self-assessment basis, you will pay. Under self-assessment basis, every month you will calculate and pay. If you go for fixed sum, for the first 2 months, if there is any shortfall, as far as you have paid 35% within the due date, no interest will be required to be paid. Then after QRMP, then we discussed about composition, GSTR 4, the CMP 08, GSTR 5, 6, 7, 8, 9, 10, 11, 5A, right? Different types of returns we learnt. Imports and exports we discussed. Import of goods mainly under customs. Import of services mainly RCM. Exception is OIDR and online money gaming. Exports, whether it is of goods or service, comes under zero rated supply. We have definition of export of goods and export of services there. Zero rated supply is export of goods and service as well as supplies to SEZ unit and SEZ developer. Or both comes under zero rated supply. Under zero rated supply, we have two options: with payment of tax, without payment of tax. Without payment of tax is under LUT. If you go with payment of tax, you will get refund of the tax paid. Without payment of tax, you will get refund of unutilized ITC. Correct. Then we discussed about deemed exports, some notified supplies, supply against advance authorization, against EPCG authorization, supply to EOUs, supply of gold by banks under advance authorization. All those are deemed exports. In case of deemed exports, it is taxable at normal rate. After the supply is over, either the supplier or the recipient can claim refund. Then we discussed about merchant exports. If you are supplying to someone who will be exporting such goods without further processing, then you will be supplying to that particular exporter at 0.1%. 0.1%, and you can claim refund of the ITC that you will accumulate. Right? That is what it says. There are conditions also there. Export of services, important point there is consideration should be received in convertible foreign currency or INR wherever permitted by RBI. Then in case of refund, next chapter, refund, there are various cases where we can apply for refund. When upon making application, 60 days they have to give the refund. If they do not give it, they have to pay us interest at 6% per annum. In case of refund, important point there is principle of adjust and enrichment. That is, you cannot claim refund after passing the incidents, right? After passing the incidents to someone else. So if the refund amount is less than 2 lakh, you will give a self-declaration. If the refund amount is more than 2 lakh, it should be certified by a chartered accountant, cost accountant, saying that it is not passed on. Incident is not passed on. In case of zero rated supplies, once you apply for refund, 90% refund should be given within 7 days provisionally. Balance refund upon further processing of the application. What is the time limit to apply for refund? 2 years from the date of from the relevant date. For zero rated supplies, we had a formula with accumulated ITC if you are claiming refund. Turnover of zero rated supply of goods plus turnover of zero rated supply of service divided by adjusted total turnover into net ITC. Here net ITC means inputs and input services only. Capital goods cannot be included. Turnover of zero rated supply of goods means actual supply or 1.5 times of domestic rate, whichever is less. Whereas in case of services, whatever amount we have received on receipt basis for zero rate supply of services. Then in case of inverted duty structure also, the formula was inverted duty turnover divided by adjusted total turnover into net ITC minus tax payable on inverted supply into net ITC divided by ITC on inputs plus input services. Here net ITC is only inputs. Right, formula. So problems also we had solved in relation to such supplies, rather such questions, right, regarding refund calculations. Then job work. In case of job work, when the principal sent the goods to the job worker, That is not a supply. Provided inputs, he will get it back within 1 year. Capital goods, he will get it back within 3 years. That requirement is not there in case of molds, digs, and dies. In that cases, even if they do not receive it, it's not deemed to be a supply. Else, in other cases, 1 year, 3 year, if he doesn't receive it, is deemed to be a supply, and he has to pay that tax accordingly. There is a return that they have to file ITC04, etc. Then we discussed about assessments, different types of self-assessment, provisional assessment, scrutiny of returns, assessment of non-filers, assessment of unregistered persons. Then audit, section 65, audit by department, section 66, special audits. Correct? So those discussions we had. Then we discussed about inspection, search, seizure, and arrest, confiscation of goods, which will be released. It can be released on provisional basis. Maximum confiscation when they take up the goods, 60 months. However, if it is perishable, etc., they can dispose it off before that itself. Right? Offenses, if the tax evasion is more than 5 crore, it is cognizable and non-bailable. If it is less than 5 crore, non-cognizable. Arrest can happen only if there is more than 2 crores. Okay, more than 2 crores only arrest. Then demand and recovery, section 73, 74, from 24, 25, 74A, there are time limits for issuance of show cause notice, time limits to pass the order. Now, under 73 and 74, we have time limit to pass the order. To issue notice, we have to work back 3 months, 6 months. Whereas 74A, they have given us the time limit to issue the notice. From that day, 12 months time to pass the order. That's a shift. Penalty payable under 73. Penalty is leviable only if you do not pay the tax within 30 days of issuance of show cause notice. Within that time, no penalty. After 30 days, if you have not paid the amount, then penalty 10% or 20, that is 10,000 per tax, whichever is higher per act. Whereas under 74, penalty starts before issuance of show cause notice itself. Before issuance, upon issuance within 30 days, upon passing the order within 30 days, beyond 30 days of passing the order. Same penalties are retained under 74A also, but instead of 30 days, they use 60 days there. 60 days time limit available under 74A. Okay, that is with regard to demand and recovery. And then we also discussed about recovery proceedings. If demand, once the order is passed, you have 3 months time either to file an appeal or pay the tax. If you do not pay the tax, then they can initiate recovery proceedings. There are various modes of recovery that we discussed. Can they give payment in installment option? Yes, if the amount is more than 25,000 and if you have not done any default earlier. Then liability to pay in certain cases, transfer of business, etc. Until the old business was happening, the old person also is jointly and severally liable. Offenses and penalties, their important discussion could be your general penalty and detention related penalty. Section 126, when they detain the goods during transit, if the supplier comes forward to pay the tax, different penalty. If they doesn't come forward to pay the tax, different penalty. And in such cases, if the transporter has to release his vehicle, what is the penalty? Penalty payable under 126 or 1 lakh, whichever is less. If he pays that, he can release his vehicle. Correct? All those, that is very, very important. Multiple times they've asked. Section 126, penalty. Compounding of offenses also we have. There are amounts that they have mentioned which you can pay and compound your offenses. Then you have appeals and revisions. Order passed by adjudicating authority or revisional authority. You can appeal to appellate authority or revisional authority within 3 months. Within 3 months, department has 6 months time. 1 month condonation will be given. Then if the order passed by appellate authority, if you are not satisfied, you have to go to GST 80 within 3 months. For first level appeal, 10% is the pre-appeal deposit that you have to pay, 10% of tax. GST 80, 20% of tax. In GST 80, there are 2 benches, principal bench, other benches. If principal bench hears your case and passes an order, the appeal directly to Supreme Court. If other benches hears and passes an order, then High Court and then Supreme Court. However, GST 80 is the highest authority for question of fact. You can go to High Court and further only if it is a question of law. Okay, then we discussed about advance ruling. There are some cases where you cannot go for advance ruling if the pending cases, if it's already pending, proceedings are pending or proceedings are already decided, if it is related to place of supply, advance ruling is not possible, not permissible. Authority of advance ruling, you have to make an application. If you're not satisfied, you'll go to appellate authority of advance ruling. If appellate authority of advance ruling says advance ruling is not possible, then there is no advance ruling for such case. If there is difference of opinion between them. Then miscellaneous provisions, there were multiple things including sharing of information, anti-profiteering measures, etc., which are, again, you can just glance through those provisions as well. Okay, that's about GST. Under customs law, we discussed that it has to come to territorial waters. Territorial waters is also part of India. Territorial waters is 12 nautical miles, right? So if it comes into territorial waters, it's considered to be import. However, leviability comes into picture only when it reaches the Indian mass. When it comes into India, customs port, there are two ways in which you can clear it. You can directly clear it for home consumption. If you're clearing it for home consumption, you have to pay customs duty, or you can keep it in warehouse, clearing for warehouse. From the warehouse, again, you can sell it directly, export it, or clear it for home consumption subsequently. Whenever you clear it for home consumption, you'll be paying the tax. However, all imports are leviable under customs duty, but there are some exceptions. You're re-importing it for repairs, etc. There are few exemptions with condition that you can look into. What is the rate? What is the date on which I have to refer the rates? Rate of duty, etc. If it is clearance for home consumption, then the rate applicable as on the date of bill of entry or date of entry inward, whichever is later. Clearance for warehousing, date of filing the bill of entry for home consumption, right? That is the dates that have to consider. The dates become important in the customs duty evaluation. Then we discussed about in case of pilfered goods, I'll get exemption, duty exemption. In case of goods lost or destroyed, I'll get exemption. In case of certain cases, if you do not want that goods, it's not as per your requirement, you can relinquish, abandon such goods for which you need not pay the duty. Then we also discussed about the different types of duty. Basic customs duty normally 10%. On that, compulsorily we have to add social welfare surcharge of 10% and IGST at the rate given normally. Apart from that, we have various additional duties, countervailing duties, right? All those discussions, anti-dumping duty, all those discussions, safeguard duties, etc. Then we went on to classification. There are schedules. Schedule 1 talks about imports. Schedule 2 talks about exports with the rules for classification, the interpretation rules. Correct. Then we discussed about valuation. In case of valuation also, we have rules. If rule 3 talks about normal valuation. If normal valuation is not happening, then we'll go with rule 4, identical goods. If that is also not happening, rule 5, similar. Then rule 7, deductive value. Rule 8, computed value. If all those things are not happening, you'll go with best judgment. Correct. There we will have to add. Rule 10 talks about certain things that you have to add. Cost of the freight, 20% of FOB or actual consideration, actual freight, whichever is. If actual freight is given, take actual freight. If actual freight is not given, 20% of FOB. However, if it is moving by air, compulsorily actual freight or 20% of FOB, whichever is less. For air, it cannot exceed 20% of FOB. Insurance on actual cost. If actual insurance is not given, not determinable, 1.125% of FOB. So whenever we calculate the customs duty or assessable value, you have to start from FOB only. So if you do not have FOB, first arrive at FOB and then add freight insurance, then get CIF. If it is in dollars, convert it into INR and apply the rate. Else directly calculate the customs duty at the rates given. Then we also discussed about the procedures of imports and exports. What are the things that they have to take care? Assessment related, faceless assessment, all those discussions we discussed. Right. Then we discussed about baggage rules. There are some exemptions up to certain limits, up to 50,000. In case of articles, personal effects, no amount, no limit. Jewelry for ladies and gents, separate discussion. More than 1 year, they have to stay abroad. Only then jewelry allowances will be given. Correct. That's important. Baggage allowance extremely important. Then you have to look into warehousing provisions. In under warehousing, what did we discuss? 3 types of warehouses: public warehouse, private warehouse, and special warehousing. Public warehouses any importer can use. Private only for specific person who got the license. Special warehouse is under the customs lock. Right. So for that warehouse, you have to get license. You have to give a warehousing bond along with security on such bond. You can remove the goods from the warehouse to another. From one warehouse to another, you can do it. You can clear it for home consumption, or you can export such goods from the warehouse. Only for those 3 purposes you can remove the goods from the warehouse. If you have paid excess customs duty, you can claim refund. Right? If they do not give the refund within 3 months from the date of application, then interest they have to pay. They have to pay you the interest. And a refund of export duty, refund of import duty, etc. points we have discussed in the refund chapter. Then the last chapter that we discussed was FTP, foreign trade policy. We have salient features of foreign trade policy. Just look into them, mainly focusing on export promotion. Status holders privilege, 1 star, 2 star, 3 star export houses, status holders important, their privileges important. Remember, 5 to 6 privileges sufficient for us from examination point of view. Even if they cannot ask beyond that, normally 4 or 5 they ask depending on the marks involved. Status of privilege holders extremely important. Then we discussed about export promotion schemes. There are 4. One is duty exemption and remission scheme. Second, under exemption scheme, we have advance authorization, duty-free import authorization conditions are there. Advance authorization means what? You can import without payment of duty. That's the authorization they have given you. Second one is duty remission. You pay the duty. After you satisfy the condition, I'll give you refund. That is duty drawback scheme. Then RODTEP, remission of duties and taxes on certain exported goods. ROSCTL, rebate on state and central taxes and levies. These are the 4 schemes that we have. Again, there are certain conditions that we have to focus on there. Then EPCG scheme, EOU, EHTP, HTP and BTP. Deemed exports related discussion. Deemed export under FTP and deemed export under GST are 2 different. Right? So what are the deemed exports under FTP? Just look into them as well. Because under GST only EOU gets covered. Here we have STP, BTP as well as EHTP that gets covered under deemed exports. Okay. These are the provisions that we have under customs, the areas that we have to focus on. Are we clear with this? Yes. Apart from this, what we are supposed to do, apart from the revising these concepts, revision material has all the requirements which are there, which are required for you for being ready for examination, including the latest amendments that is also given. Along with that, the suggested answers, RTPs, MTPs do not miss, as well as your case scenario booklet that has MCQs, right? There are chances that they can pick it from that itself and change the names, figures, etc. And solve all those case scenarios, as well as your model test papers. Every subject you have you have set of model test papers. Go through them as well, because those questions are very good, okay, really good, which are in the standard as examination itself. So you can just glance through those or go through those model test papers as well, which will definitely help your preparations. Okay, these are the things that we'll have to focus on. Everyone clear? Yes, sir. Yes, if that's the case, shall we conclude? Yes, we had a complete overall view on this entire subject with special focus on important aspects. Okay, that's what we have done. Based on this, build upon, especially those who are in September examination, based on this base is sufficient for you. Use the revision material and CAPS material to further build upon, solve problems. Solving problems is very, very important so that you will be equipped to write the examination. Okay, fine then. So I think you have a session, you have a meeting now. You can join those meetings. Okay, I'll just conclude the session. Okay, fine. If anyone has any doubts, we can discuss it. We'll conclude. No? Okay, good to go. Fine then. We'll conclude. Okay, thank you.
Thank
Thank
you,
you,
sir.
sir.
Thank you, sir.
Thank you. Bye.